Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Phil Mackintosh, chief economist at Nasdaq. We are going to discuss how stocks are faring so far in September, as we are just about exactly at the halfway point. And Phil, markets have kind of been struggling to sideways to kick off the month. What exactly has changed compared to what we saw in August when they were just going straight up?
Yeah, I mean, in a lot of ways, not much has changed because the data really hasn't changed that much. But in other ways, a lot of data has started to change subtly. So if you look at COVID, we're starting to see a reduction in hospitalizations. That's a good thing because it should mean we're going to come back from the economy, back to jobs. But that also means the economy might overheat. We've also seen, though, a lot of people have stopped spending because of the COVID spike. And so potentially there's actually a downdraft on leisure and hospitality jobs because there's people going on less vacations, less hotel visits, less spending at restaurants. So there's quite a few things that have actually changed. The manufacturing sector is starting to slow. And overall, I think you can sort of see the economy is not as red hot as it was a month ago.
And it could also be that the market's in a holding pattern because, of course, we have the Fed meeting next week, which everyone's going to be focused on. And, of course, that means the discussion around inflation will really resurface. How did you interpret the CPI data and some of the other manufacturing data that has come out this week? And how could that impact the Fed's thinking?
Yes, I mean, the CPI data that came out last week was pretty much in line with what the Fed's been saying, and a lot of people haven't been believing, which is the inflation's transitory. So if you look at a lot of the factors that were driving inflation up, sure, the rolling 12-month number stays pretty high on a multi-decade basis, but you're starting to see vehicle rentals, vehicle sales, hotels, airline tickets, all starting to go back down again. So that spike or the recovery trade that we had seen, the sort of supply shortages in cars, does look like it's going away. And so the Fed probably liked the numbers because it means they're probably more close to right on the transitory nature.
And with that, of course, with the slowdown in data, we're seeing the 10-year move lower as well. So shouldn't that, in theory, be good for stocks?
I mean, normally when rates go down, valuations and multiples can go up. I guess what we're seeing, though, is the slowdown in the economy generally as well. So maybe there's a little bit of pressure on earnings, and people are starting to factor in. Things aren't as hot as they were. Stimulus has run out. A lot of the people's savings are starting to drain down, and we're starting to see a little bit less activity in the market. So potentially it's actually more of a normal than an old stimulus red hot economy.
All right, well, that's why they call it cycles, right? All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.